So in this video, I'm going to go through the most popular ETFs, what the differences are between them, what kind of sector exposure you can expect to get with these, and hopefully help you decide what ETFs that you as a beginner investor would want to invest in. Now, I found the best app to find out more information about ETFs is actually InvestEngine, a platform that I already very highly recommend. So if you do want to sign up for the app, make sure to use the link in the description down below. So InvestEngine lets you invest in over 550 ETFs. So in this video, I'm going to show you the most popular S&P 500 ETFs that you can find on InvestEngine and what the differences are between them, because I get this question quite a lot. So the first is the iShares S&P 500 by iShares with the ticker code IUSA. So it is important to note that when the ticker code is different, the actual specifics of that fund will change. So this S&P 500 is offered by iShares. iShares is a massive company owned by the BlackRock group, and essentially what every ETF does is to track the S&P 500. So this is the actual S&P 500, and what you'll notice here is that it is in points. So currently it is at 4,133 points, and as you can see at its peak it was around 4,700 points. So points doesn't exactly correlate with the currency, and this is where different ETFs come in. So this ETF is in pounds, and as you can see it's very different from the point system. So each ETF, so each index fund, tracks the S&P 500 in slightly different ways. So the first most important thing to note is the total expense ratios. So it's this number here. Investors in the USA are very lucky because Vanguard offers total expense ratio of the S&P 500 in some cases to be as low as 0.03%. The higher the total expense ratio, the more potential gains that you will lose from fees. In my personal opinion, anything over 0.3% is getting very, very expensive. So you realistically, for one single ETF, you should be looking at anything under 0.25%. I made a video explaining everything to do with this number, so make sure you do check out that. Although we see the profile of this graph very similar to the original S&P 500, it is not exactly the same. So as you can see, in the past year, it is down by 1.56%. If we look at the original index in the past year, it is down by 3%, and there have been major differences between that. This is because this index offers the S&P 500 tracked in terms of pounds. And now there are a lot of differences between the exchange rate between the dollar and the pound. In addition to that, the S&P 500 is mostly all dealt in dollars. Most of the companies in the S&P 500 will deal in dollars. However, some of the companies are very exposed to international markets. For example, Apple, because iPhones are everywhere, they might be receiving a lot of their income in local currency, for example, in Japanese yen, and that needs to be converted into dollars, meaning that there will be differences within currencies. When it comes to investing in pound, last year we saw a huge difference between the pound and the dollar, meaning that any returns that you got in the S&P 500 in terms of dollar meant less of a loss for us investing in the UK because the dollar was stronger. However, going forward in the future, the pound may well recover, meaning that any returns that we get in the dollar are going to be worth less than the time you bought right now. So that is very much worth considering. So what I really like about InvestEngine is that it has an ETF breakdown. So it shows you all the companies that this ETF invests in, going from the holdings to the regions. So you can see that it is mostly exposed in America. So North America 96%, UK 1.4%, Europe excluding the UK 1.3%, and the rest of the world 0.9%. Also shows the sector. So for example, industrial and tech are top, financial, consumer, healthcare, and then the rest are energy, mining, and property. You can even press show all to show all the companies that this ETF invests in. So the S&P 500, you might be thinking 500 companies, but it is up to each individual fund manager and ticker code to decide best how they want to invest in the index. So as you can see, this index has 499 holdings, the top being Apple, Microsoft, Alphabet, Amazon, Nvidia, Tesla, Meta. The reason why I didn't mention Berkshire Hathaway is because excluding Berkshire Hathaway, the top few companies are all very heavily tech-based companies, meaning that the S&P 500 is very heavily weighted in terms of market capitalization in technology. So that is something to take into consideration, because as we see at the beginning of most recessions, the tech companies are the ones that would go down first, meaning that because you have a lot of exposure in tech companies, you're going to see a lot of volatility in times of hardship. But the reverse will also be true in times of prosperity, where tech companies are going to be making a lot of money, meaning that the index will also fly around with it. So again, if you want to actually find out which sector a certain amount of companies is in and filter them by sector, you can do that. So for example, healthcare, there's actually 21 holdings in terms of healthcare, and you can see all these companies and the percentage weight they have in terms of their market cap. So I always get the question, are S&P 500 indexes all the same? And they are definitely not. So the other thing that differentiates ETFs is this thing here. So this ETF is distributing income. So this is a distributing ETF. So this is another very important thing to look at. To ask yourself, is the ETF accumulating, meaning that it automatically reinvests dividends, or is it distributing, meaning it gives out dividends as cash payments? So if you're holding this ETF, for example, outside an ISA, you are liable to pay taxes on your dividend gains, even on an accumulating fund and a distributing fund. So bear that in mind. If you're making over £1,000 in dividends, you're going to have to declare that to HMRC. If you did want to find out the dividend yield, unfortunately you're going to have to go into the fact sheet. So this is the fact sheet for the iShares S&P 500 ETF, the IUSA, and if you wanted to find out the dividend yield, it is here under distribution yield. So it actually pays out 1.36% as an annual rate. So it pays out 4 times a year every quarter. However, the total amount added up will be around 1.36%, but this will always fluctuate based on the share price of the ETF. While we're here, we can also see the history of the ETF on the past few years. Most of these ETFs are newer, so their history going back won't be that long ago. So this one has history all the way back from 2002. So there's also more information here. For example, the sector breakdown, which we can get from InvestEngine anyway, and the geography breakdown, which is actually contradicting what InvestEngine is saying. However, when they break down something and say that they are in the United States of America, they might mean something like Apple, which isn't 100% in the USA. So take that for what it is, but I would just go with InvestEngine's information because it looks deeper into where these companies are operating. So like I said, I get a question a lot, are these ETFs all the same if they say S&P 500? And the answer is no. And all this information will be found in the key investor information pack, and InvestEngine makes it very easy to just press it and download the PDF. So this is the key investor information pack for the IUSA, and I must admit most people won't actually read this, especially if you're a beginner investor. So I'm just going to quickly skim through what makes this ETF different from the other one, and then we're going to look into the Vanguard VUSA and then compare the differences. So one of the details that you might miss out of this fund is that they say that this fund may include the strategic selection of certain securities that make up the index, or other securities which provide similar performance to certain constituent securities. This is a fancy way of saying they might choose certain securities or certain companies in different allocations over others in order to make sure that this ETF tracks the S&P 500 in the way that this fund actually intends to. Furthermore, they might be using FDIs, so these are financial derivative instruments, and also the fund may engage in short-term secured lending. This is nothing to worry about, but essentially each ETF has to make certain decisions about how they're going to track. There is no such thing as perfect tracking. Each ETF will be liable to something called a tracking error. There is no way to track the original S&P 500 in terms of points to pounds. There's always going to be some error in that. In order to mitigate some of these errors, each fund provider, for example iShares, and for each ticker code will be using different instruments in order to track the market in the way that they intend to. So now I'm going to go through the VUSA, by far the most popular that I see all over YouTube for UK investors. And lastly, I'm going to show you my favorite S&P 500 and how that is different from all the other ones that I've showed today. So this is the Vanguard S&P 500, and in my previous video I showed you how John C. Bogle of Vanguard revolutionized the way that we invest by creating the first index mutual fund. And as you can see, this profile is very similar to the iShares S&P 500 IUSA. In fact, it is very similar, and it is based on pounds. The total expense ratio is exactly the same. However, we can see the breakdown, and this fund actually has less holdings than the iShares S&P 500. And as you can see, Apple was 7% back in the other fund, and Apple is 6.5% here. Essentially, each ETF will actually decide the way that it is weighing these different companies. We see that the VUSA has a few less companies. The S&P 500 itself has more than 500 companies. However, the VUSA, by InvestEngine's measurements, has 496 holdings. Honestly, this is nothing to worry about. However, let's go through the key investor information pack and see what Vanguard does differently in order to provide their ETF. So objectives and investment policies. The fund employs a passive management. We know that. The total expense ratio is very low because it is passive and not actively managed. So here we see the fund attempts to track the performance of the index by investing in all the constituent securities of the index in the same proportion as the index. So unlike the iShares S&P 500, 500, the Vanguard S&P 500 aims to track the S&P 500 exactly how it is, meaning that the changes in the S&P 500 in terms of points will be reflected in the dollar amount that comes back into the fund. However, this ETF is not hedged, meaning that any differences between the dollar and the pound will be reflected in the amount that you return. For example, if the dollar is stronger than the pound, you're going to receive a higher value because the dollar is stronger. Conversely, if the pound becomes stronger than the dollar, any amounts received from the index, which is going to be in dollars, is going to reflect less on you in terms of pounds. Number two is that the VUSA will remain fully invested except in extraordinary market conditions. This basically means that the VUSA is committed to keep tracking the S&P 500. It does say that the fund may use derivatives in order to reduce risk or costs. The base currency, like I said, was in USD, so United States dollar. The fund invests in securities which are denominated in currencies other than the listing currency, and some other big stuff here. If that answers the question, the difference between the VUSA and the IUSA is that the VUSA tries to track the S&P 500 a bit more to the point. However, one big difference between the IUSA is that it does change the allocations of some of the securities, but overall I don't think you're going to see much difference between the VUSA or the IUSA. The number you see here is nothing really important. Just because the number in the IUSA is a lot lower does not mean anything. It just means the fund started later on. This ETF started a lot earlier in life, so then the value has just increased as it has accumulated investors' money. So I personally won't make my decision based on what the cost of the fund is. But that being said, if the cost of the fund is lower, you can buy a lot more shares. If you're using a platform that doesn't allow fractional trading, you can buy a lot more shares, which will mean less money left in cash. And speaking of lower value, this is the final S&P 500 fund I'm going to show today, and it is by far my favorite. So this is the iShares Core S&P 500 by iShares, and it has the ticker code GSPX. So this is actually very different from the previous two, not only because it costs a lot less, but because the profile is very, very different. Now we can see the profile is a lot similar to the actual S&P 500. As we can see, the dip was a lot lower. So the S&P 500 in the USA, the actual index, dipped over 20% since 2021. The VUSA and the IUSA didn't drop 20%. This is because as the pound became weaker against the dollar, the amount returned didn't result in a huge drop. Now this could be an advantage if you're a UK investor, but in the long term I don't think currency differences are going to make much of a difference if you're investing for over 40 years. However, for the short term I do like the S&P 500 because of its volatility. As you can see, there's been a huge drop since 2021 from £8.38 to all the way down to £6.34. So this fund is very different because it has this symbol here. So it is a hedged fund. So first of all, we do see it is distributing, so it does pay out dividends. But the important part about this ETF is that the currency is hedged. So currency hedged ETFs are designed to protect investors from exchange rate movements when holding overseas assets. So they use currency derivatives in order to kind of balance out the changes between the dollar and the pound, meaning that this tracks the S&P 500 almost exactly from the points basis to the pounds basis. In order to provide this hedging, however, the total expense ratio does become more expensive. It becomes 30% more expensive, which in the long term will eat into your funds. So now I know most people aren't mathematicians, but the difference between 7% and 10% is actually 30% and not 3%. So it's a lot higher than you'd think, and you have to decide for yourself if it's worth actually paying the extra fees to get the hedging. I personally think that it is, just based on the fact that I like to see the volatility, meaning that when you are dollar cost averaging for now anyway, you're buying much lower when the US drops lower, and when it comes to the next bull market, which will see the next peak, you're going to be just buying more lower, and then maybe at the peak you can sell or whatever. I think in the short term it's good, but for the long term, honestly, it's up to you to decide if you want to pay that extra fee. So if we go into the breakdown, again, this is almost identical to the IUSA amounts. So 499 holdings, with Apple being 7.2%. So if you want to find out more about the hedging, your shares will be hedged with the aim of reducing the effect of exchange rate fluctuations between their denominated currency and the fund's underlying portfolio currencies. The hedging strategy may not completely eliminate currency risk, that is very true, and therefore may affect the performance of your shares. So there is a pro and a con to actually getting a hedge fund. The hedging is never absolute, it is never perfect. You might end up losing more money through the hedging. Also, if there are big shocks in the system and the fund doesn't have enough money to cover its hedges, that can also affect the performance of your fund. So going for something like the VUSA and the iShares S&P 500 IUSA for the long term is probably a better option than going for a hedged fund. So make sure to check out some of my other videos, and I will see you in the next video.